Stop scrolling. Tell your plants you'll water them later. Tell your dog to stop barking. Yes, even your wife. Tell your goldfish to stop judging you through the glass. Are we clear? Good. Because what I'm about to tell you is going to blow your mind. It's going to make you angry. It's going to make you want to throw your phone across the room. But it's also going to make you smile. Ladies and gentlemen, Asian guy here. Today is Thursday, January 15th, 2026. And I'm about to tell you something that sounds absolutely insane. Yesterday, Wednesday, January 14th, we talked about how the spread between New York and Shanghai exploded to 13. We talked about Shanghai trading at $104 while New York was stuck at 91. We talked about how this proved the paper market was dead and the physical market had taken control. And then yesterday afternoon, something happened that I did not expect. Something that changes everything. JP Morgan, the bank that has manipulated the silver market for 15 years, the bank fined hundreds of millions of dollars for spoofing. The bank everyone in the silver community loves to hate. Just flipped. They switched sides. They went from being the largest short in the silver market to being net long. They dumped their shorts. They covered their positions. And now they're buying physical silver with both hands. Not to suppress the price, but to profit from the explosion. And if you don't understand what this means, you are going to miss the biggest opportunity of your life. So stop. Listen, let me explain exactly what happened in the last 24 hours, because this changes everything. Now I know the obvious question. John, how do you know JP Morgan flipped? How do you know they covered their shorts? Great question. Here's how I know. Yesterday afternoon, silver in New York collapsed $8 in just 4 hours, from $93 down to $85. If you were watching the chart, you probably panicked. You probably thought, that's it, the rally is over, the banks won. But that's not what happened. What you witnessed was a massive short covering event. Let me explain. When you're short a commodity, you borrow it and sell it, hoping to buy it back later at a lower price. But when the price rises, instead of falling, losses pile up, and eventually you're forced to buy it back. That's called covering your short. And here's the key. When you cover, you become a buyer. But if you're a massive bank that needs to cover millions of ounces, you can't just start buying openly. The price would explode and you'd pay far more than you want. So what do? You crash the price first, you dump paper contracts, you create panic, you trigger stop losses, you force retail traders to sell, and while everyone else is panicking, you quietly buy everything. That's exactly what happened. JP Morgan dumped paper silver to crash the price from 93 to 85s. Retail panicked and sold. JP Morgan bought it all. They covered nearly all of their short exposure in a single afternoon. How do I know? Because if that selling were real, if real supply had entered the market, the price would have kept falling. $80, $75, $70. But it didn't. It stopped at $85 and stabilized. Why? Because JP Morgan stopped selling once they were done covering. They got what they wanted. And now, for the first time in 15 years, JP Morgan has no reason to suppress silver. In fact, they have every reason to let it run. They're long. They own hundreds of millions of ounces of physical silver. Every dollar up is now profit. This is the end game. The biggest bear in the silver market just became a bull. And when the biggest bear turns bullish, there is no ceiling. Now I know some of you are angry. You're thinking, JP Morgan manipulated silver for years. They crushed rallies. They screwed retail. And now they get to profit on the upside too. You're right. It's not fair. But fairness doesn't matter. Positioning does. Because here's the reality. For 15 years, every silver rally died for one reason. JP Morgan was short. Every dollar up was a dollar they lost. They were the ceiling. But now, they're not the ceiling anymore. They're the floor. Ask yourself this. If JP Morgan owns hundreds of millions of ounces of physical silver, do you think they'll allow the price to crash? Of course not. They'll buy every dip. They'll defend the price. They'll use the same dirty tricks, only this time to push silver higher. This is the most bullish development imaginable. If you own physical silver, you're now on the same side as the shark, and the shark is about to feed. Now here's what JP Morgan knows that most people don't, yet. They know China is about to vacuum up every remaining ounce of silver on Earth. They know the Shanghai premium isn't going away. They know the shortage is real. They know industrial demand is exploding. They know the vaults are empty, and they know the Western world hasn't caught on, yet. But when it does, when Tesla, Apple, and Samsung realize they can't secure supply, when pension funds and sovereign wealth funds pile into silver as the dollar weakens, the price won't rise. It will go vertical. And JP Morgan wants to be positioned before that happens. This isn't speculation, this is positioning. And the game has just changed. They want to front run the herd. That's the entire strategy. Accumulate as much physical silver as possible while retail is still scared, while prices are still sitting around $90 or $100, because they know what's coming. They know that 6 months from now, 12 months from now, silver won't be $100. It'll be $200, maybe $300. And smart money always buys cheap before the crowd wakes up, not after. This isn't some wild conspiracy theory. This is basic market behavior. This is how capital moves. The smart money sees the trend, understands the fundamentals, and positions early. And right now, those fundamentals are screaming. JP Morgan sees it, and they're lining up for what could be the trade of the century. Now let's talk about what's happening to retail investors. Because while banks are loading up, regular people are getting locked out. Yesterday, APMEX, one of the largest bullion dealers in the United States, announced a new rule, a $10,000 minimum to buy silver. $10,000. At $90 an ounce, that's about 111 ounces. Most people don't have that kind of cash ready to deploy. That's a massive barrier, and it's not an accident. APMEX isn't doing this to punish customers. They're doing it because inventory is tight. They're rationing supply. They're prioritizing whales, institutions, and banks. The small buyer, the person who wants 10 or 20 ounces, is being pushed aside. This is the lockout. This is the moment when retail loses access to physical silver, and it's happening right now. And it's not just APMEX. Scottsdale Mint's CEO, Josh Fair, recently said it openly. The silver market is now institutional. This is no longer retail versus banks. It's banks versus banks. Institutions fighting each other for what little supply remains. Retail is getting squeezed out by design. The big players want the metal for themselves. The gates are closing. The doors are locking. And if you're not already inside, you may not get another chance. So if you've been waiting, sitting on the fence, hoping for a dip back to 70, I've got bad news. It's not going back to $70, and even if it did, you wouldn't be able to buy it. Dealers would be sold out. Mints would be backed up. Minimum orders would still be 5 figures. The physical market is disappearing. If you want silver, the window is right now before it closes completely. Let me walk you through how we got here, because none of this should be a surprise. We've been saying for months that the commercial banks aren't stupid. They see the same data we do, actually better data, and we said they would flip eventually. Now they have. Go back 6 months to July 2025. Silver was around $30. JP Morgan, HSBC, and other commercial banks were massively short, sitting on hundreds of millions of ounces in paper positions, suppressing price, printing money. But then the data changed. Physical supply started tightening. The Shanghai Premium widened. China's export licensing system came into focus. Vaults started draining. The banks saw it, and they realized the old playbook, short forever, was no longer going to work. So they changed strategy, quietly, methodically. They'd crash the price, create panic, cover a portion of their shorts, let it recover, crash it again, cover more. That's why the second half of 2025 was so volatile. It wasn't chaos, it was JP Morgan unwinding. At the same time, they were accumulating physical metal, pulling bars out of COMEX vaults, building a hoard. And we told you this was happening. Yesterday was the final confirmation. The 8 smash from 93 to 85 was in T, the end of the rally. It was the last gasp. The final cleanup, the moment JP Morgan finished covering and flipped fully net long. And now the game has changed. Here's what comes next. And this is the critical part. JP Morgan isn't buying physical silver for a 10% trade. They're positioning for $300, $400, $500 silver. And they're not going to allow deep pullbacks anymore. Why? Because lower prices invite competition. A dip to $80 brings in retail, hedge funds, sovereign buyers. JP Morgan doesn't want competition. They want accumulation without resistance. So what do? They push price higher, slowly at first, then faster. They trigger breakouts. They activate algorithms. Momentum traders jump in, media coverage ramps up. And while everyone piles into paper, JP Morgan sells paper strength and keeps the physical. That's the real prize. This machine is already running. Silver isn't going back to $80 or $70. It is heading to $100, then $120, then $150. And once $150 hits, mainstream media wakes up. CNBC starts talking, silver becomes the new Bitcoin. FOMO kicks in. And that is when the real move begins, 150 to 250s to 350, because the physical shortage never went away. Demand is still exploding. Vaults are still empty. And now the biggest bear has turned into the biggest bull. Now, a warning for anyone thinking about selling out of spite. If you sell because you're angry at JP Morgan, you're not hurting them. You're helping them. They're the buyers. They want your silver. Selling now is handing them your winning ticket. Don't do it. Hold your metal. Let the shark work for you. You don't have to like JP Morgan. I don't. But when your interests align, you don't fight it. You ride it. Be smart. Be unemotional. Hold your silver. and let the biggest force in the market push the price higher for you. The fundamentals changed. Central banks stopped selling gold and started buying it. The dollar began to weaken. Deficits started spiraling out of control. And the commercial banks realized the rules of the game were no longer the same, so they adapted, they covered their shorts, they flipped long. And what happened next? Gold went from $250 in 2001 to nearly $1,900 by 2011, a 760% move. The banks made a fortune. They went from bears to bulls and rode the entire wave higher. And now history is repeating, but this time in silver. The commercial banks are flipping again, short to long. And the move in silver is going to be even bigger than gold. Why? Because the silver market is smaller, because industrial demand is far higher, and because the shortage is far more severe. We're not talking about a double or a triple. We're talking about a potential move from $30 to $300 or more, a 10x. And if you're holding physical silver, you're already positioned. Now let's talk about China, because China is the key to understanding why JP Morgan is moving right now. JP Morgan knows China is about to vacuum up every remaining ounce of silver on Earth. They know the Shanghai Premium isn't temporary. They know China's export licensing system has created a one-way valve. Silver flows into China, but it doesn't come back out. And they know China's industrial engine is accelerating. Solar is expanding. EVs are exploding. Electronics are scaling. Every one of these industries needs silver, more silver than the world can produce. So China keeps buying, Shanghai prices keep rising, and eventually the Western price has to catch up. These two markets cannot stay disconnected forever. At some point, the arbitrage breaks so violently that something snaps. Maybe it's a delivery failure. Maybe it's force majeure. Maybe it's government intervention. Whatever the trigger, the Western price will gap up to meet the Eastern price. And when that happens, anyone holding physical silver wakes up to a life-changing windfall. JP Morgan knows this. They saw the Shanghai data months ago. They watched the premium widen. They watched vaults drain. And they made the decision, get out of shorts, get long, now. They front-ran China. They positioned ahead of the herd. And today they're sitting on hundreds of millions of ounces of physical silver, waiting for the West to wake up to a reality the East already understands. This isn't luck. This is game theory, strategic positioning, chess, not checkers. Now zoom out, because this isn't just about silver. This is about the dollar, the global reserve currency, the foundation of American financial dominance. The Shanghai Premium isn't T widening only because of silver scarcity. It's S widening because confidence in the dollar is eroding. The East doesn't trust the Federal Reserve. They don't trust U.S. debt. They don't trust that the dollar will hold value. This isn't a sudden collapse. It's a slow bleed, a gradual loss of confidence that accelerates over time. And JP Morgan sees it. They see where this ends. They know hard assets are going to reprice violently higher as fiat loses credibility. They're rebuying silver, not just because of a squeeze, but because they believe the dollar itself is dying. And when the reserve currency breaks, gold and silver are what survive. This is the end game we've been moving toward for decades. Now here's the playbook for the next 6 months. Short term, next few weeks, price consolidates between $90 and $100. JP Morgan keeps accumulating, buying every dip, putting a floor under the market. Price grinds higher, not vertical, controlled. Then comes a catalyst, maybe a COMEX delivery failure. Maybe a major industrial buyer admits they can't source silver. Maybe China tightens exports again. Maybe the Fed announces more QE. Whatever it is, price gaps $100 to $120 or $130 in a single session. That's when media wakes up. That's when retail FOMO starts. That's when momentum traders pile in. And that S, when the real move begins, 130 to 180 to 220. By 220, physical silver is gone. Dealers are empty. Mints are shut down. Premiums are $30, $40 over spot. The only way to get silver is to pay whatever the seller demands. And that's when we go vertical, $220 to $300. $300 to $400, maybe higher. Because at that point, the system is breaking and silver isn't an investment anymore. It's a lifeboat. Now let's address the fear that JP Morgan will rug pull the market. What if they pump it to $200 and dump? Simple answer, they won't. If they dump at $200, price crashes and China buys everything. Supply disappears. JP Morgan loses the real prize and misses the generational move to $300 or $400. We're not stupid. They're not trading for lunch money. They're positioning for history. They know the shortage is real. Demand is real. The dollar is weakening. And silver is the ultimate hedge. So stop worrying. They're not dumping. They're holding. And so should you. Final message. JP Morgan flipped. Shorts are gone. They're long. The biggest bear is now the biggest bull. The ceiling is gone.